Okay, hi, Assalamualaikum. I will discuss for the question number 1. Discuss banks' risk management framework, risk management process, and risk appetite policy. Okay, for risk management policy, the HSBC management decide to design, to identify and analyze the risk, set appropriate risk limits, and control and monitor the risk and limits up-to-date administration information system. Therefore, regularly monitor risk management policies and system to reflect changes in the market and products. For the question number 1, executive committee and board committee, their function is to formulate risk management policy, to monitor risk and review the effectiveness of the risk policy. For board risk committee, their function is to responsible to see the senior management activity such as their credit risk, market risk, liquid risk, and operational risk, and so on. And then next question is I will present about the number 2. Which is examine banks' 3 lines of defense. Okay, for HSBC Amanah, they are having 3 lines of defense, which is the first one is they are taking on the risk and responsible for identify, record, report, and manage them and ensure that the right control to mitigate the risk. And then for the second line, they assess the policy and guidelines for manage the risk and provide advice to the first line of the bank. And then the last one of the bank line of defense is their internal audit, which help the board and executive committee to protect their assets. And then for the question number 3, discuss fiduciary and oversight function of bank directors. Okay, for the function of bank directors, the board is responsible for overseeing the management of the bank and reviewing the bank strategic plans and key policies. Although the board delegates the day-to-day management of the bank business and implementation of strategy to the executive committee, certain matters including annual operating plans, risk appetite and performance targets, procedure for monitoring and controlling operations, approval of credit and market risk limits, specified senior appointments, and any substantial change in balance sheet management policy are reserved by the board for approval. That's all for me.
So I will present for number 4. Question number 4 is how bank identify and mitigate the risk in murabahah financing. So first of all, murabahah financing in the Islamic bank declare that the murabahah purchase order, that whether it is binding or non-binding. Murabahah financing is where bank sells assets which is already owns to the customer at cost plus murabahah profit, plus based on the promise to buy. So HSBC Amanah bank identify and mitigate their risk through stages to have better planning for the implementation of suitable tools to overcome the risk. Then, in order for them to identify the risk, they allocate the risk into the different group which are unique, which consists of return risk, Sharia non-compliant risk, displaced commercial risk, equity investment risk, and generic that consists of credit risk. They also market risk, liquidity risk, and operational risk. So as we mentioned, those are actually the overall first stages in any risk that occur in which need to be classified into class to have better planning on the implementation of tools. So the murabahah financing on the identification and mitigation also need to go through this early stage to have proper flow of risk migration. So as the mitigation of risk, HSBC Amanah proposed various of tools as a guideline to overcome risk based on the type of risk that already being identified before, which are credit risk and also market risk. For example, the guideline is the pricing metric guidelines, acceptance letter offer, negative leads, collaterals guidelines, valuation guidelines, discretionary guidelines, and consumer grading guideline. So through those guidelines, a few market risk tools as mitigation of risk being implemented as below. For value at risk, historical simulation, VAR, COVAR, methodology, Monte Carlo simulation. Then for issues for Islamic Bank is limited data, liquid instruments, need to use conventional price proxies, higher confidence interval, and long time horizon. That are some kind of issue. Then move on to the question number 5, which is financing impairment. Expenses were charged to depositors and shareholders. And we need to find the returns of Mudharabah investment depositors, ROMD, and returns on equity. So return on equity, the formula for return on equity is net income divided by the shareholders' equity. So we have return on equity in the year of 2017 is recorded at 0.213%, and it considered as bad performance by HSBC Amanah. So next we go to return on Mudharabah investment deposit. So the formula for return Mudharabah investment deposit is net income divided by total Mudharabah investment. So even though HSBC Amanah managed to gain a higher number of Mudharabah investment in 2017, but the net profit just managed to increase by a fraction, thus resulting in a drop in ROMD. The drop from 8.011% to 2.78 can be quite significant. Next to the question number 6, which is analyze and discuss banks Islamic securities held for trading, which is STA. So we need to calculate the ratio of STA. So for STA, which is total assets and also financial asset that held for trading. So in order to get STA, the financial asset that held for trading will be divided with the total asset. So securities held for trading here is compared between year 2017 and 2016, and we can see that it is recorded increase from 2016 to the 2017. That's all from me. Thank you.
I'm going to talk about my part, which is the income gap and the derivatives of the use of the derivative of the bank and what is the purpose of it. So based on the calculation that I did of the income gap, the results shown that HSBC Bank is facing the negative income gap due to the higher amount of their liabilities and compared to the asset value. So this situation tend to happen towards the organization due to the reason of maintaining the financing product using the fixed rate that could lead to huge impact on the fluctuation of interest rate being set up by the Bank Negara Malaysia. Most of the Islamic bank and institution experienced this situation before during financial crisis. However, throughout the current practice, most of the Islamic institutions tend to change few of the product to the variable rate and remain with the fixed rate due to reason of avoiding the prohibitions element in transaction, which is GARA. But so moving on, the conventional institution managed to maintain their profit gain due to the implementation of variable rate on the financing and deposit products. The financial crisis could impact more on the conventional practice due to the system being implemented by Islamic institution to cater the loss incurred. However, the Islamic institution could receive more on the implementation of fixed rate on the financing product. But there is no comment on the prohibition of the variable rate to sustain the profit gained by the institution. At first, it seems to be one of the prohibition elements according to Islamic jurisdiction, But however, the changes on the profit rate by the Islamic institution are permissible due to reason of deferment of payment. In terms of changing in price, it's actually in practice did not breach any regulation in Islamic jurisprudence because in order Islamic institution wanted to implement the variable rates, they should put the highest profit in the documentation to avoid gara, so that it could occur due to the changes in the profit rate. So I hope for the income gap explanation is quite straightforward. So I'm gonna move to the use of derivatives in the bank and what is the purpose of it. So derivative is a financial security with a value that is reliant upon or derived from an underlying asset of group of assets and a benchmark. So the derivative itself is a contract between two or more parties, and the derivative derive its price from fluctuations in the underlying asset. But the most common underlying assets for derivatives are stocks, bonds, commodities, currencies, interest rates, and market indexes. These assets are commonly purchased through brokerages. Derivatives can take over the counter, OTC, or an exchange. So OTC derivatives constitute a greater proportion of the derivatives market. So OTC traded derivatives generally have a greater possibility of counterparty risk. Counterparty risk is a danger that one of the parties is involved in the transaction that might default. So these parties trade between two private parties and unregulated. Conversely, derivatives that are exchange traded are standardized and more heavily regulated. So based on HSBC annual report, the group and the bank use derivatives such as profit, cash flows, financial assets, and liabilities. Derivatives are financial instruments that derive their value from the price underlying items such as equities, profit rates, or other indices. Derivatives are initially recognized and subsequently pre-measured at fair values. So the fair values of exchange traded derivatives are obtained from quoted market price. So the fair values of OTC derivatives are obtained using valuation techniques, so including the discounted cash flow models and option pricing models. So the derivative assets and liabilities arising from different transactions are only offset for accounting purposes if the offsetting certain are met. So the derivatives may be embedded in the other financial instruments. So let me give you an example. For example, a convertible sukuk with an embedded conversion option. Embedded derivatives are treated as separate derivatives, and when their economic characteristics and risks are not clearly and closely related to those of the host non-derivative contract, the terms of the embedded derivatives would meet the definition of standalone derivative. If they were contained in a separate contract and the combined contract is not held for trading or designated at fair value, the embedded derivatives are measured at fair value with changes in recognize their profit or loss. So derivatives are classified as assets when their fair value is positive, or as liabilities when their value is negative. Derivative assets and liabilities are arising from different transactions and to the offset if the transactions are with the same counterparty and an illegal right of offset exists and the parties intend to settle the cash flow on a net basis. So the method of HSBC recognizing the fair value gains and losses depends on whether derivatives are held for trading or are designated as hedging instruments. If the latter and the nature of the risk being hedged all gains and losses from changes in the fair value of derivatives held for trading are recognized in the statement of profit or loss and other comprehensive income. When derivatives are designed as hedges, the bank needs to classify from them as either hedges of the change in the fair value of recognized assets or liabilities, or from commitments of fair value hedges, or secondly, hedges of the variability in highly probable future cash flows and attribute to a recognized asset or liability or a forecast transaction. Thirdly, hedges of net investment in a foreign operation. Hedge accounting is applied to derivative designated as hedging instrument in a fair value cash flow or net invest hedge provided.
Okay, thank you Alia for your part. Right now I will be answering about question number 9. I have asked to critically analyze the allocation of funding into deposit and investment funds as of December 2014. IFSA is a short form for Islamic Service Act 2013. The Act was gazetted on 22nd March 2013 and came into full force on 30 June 2013, replacing the Islamic Banking Act 1983 and also Takaful Act 1984, Payment System Act 2003 and also Exchange Control Act 1953. The Act provides for the comprehensive regulation and supervision of all activities of an Islamic financial institution in order to promote financial stability and compliance with Sharia. This distinction between products will allow Islamic banks to develop a wider range of products for both Islamic deposit and Islamic investment to meet the diverse needs of the customers. According to Bank Negara's article, such flexibility has led to the development of Islamic deposit products based on various Sharia contracts such as Wadiyah, Qard, Tawarruk, and also Wakalah with Mudarabah. Thus, after the Act becomes effective as of December 2014, Islamic financial institutions must inform customers about the changes to their deposit account. This is because after so many years, the public has already familiar that Mudarabah contract is commonly used for Islamic deposit. Islamic financial institutions also must replace the currently used Mudarabah current account and saving accounts. Both accounts will no longer be classified as deposit. Instead, they are officially changed into an investment account. This is because of the nature of Mudarabah contract that is different from the definition of Islamic deposit. In Mudarabah, customers will act as Rabul Mal, while Islamic Bank as Mudarib that will manage customers' deposit to generate return. As Mudarabah does not guarantee a return, it will depend on the performance of the investment. Any losses will be borne by Rabul Mal unless there is an evidence of negligence by Mudarib. Plus, according to Malaysia International Islamic Financial Centre, it is worth noting that the global Islamic finance industry has seen some key development in the end of 2014, as the industry achieved several milestones and continues to move towards greater sustainability and providing a wider range of financial services. Several landmark regulatory advances were made and continued innovation, including Basel III compliance sukuk for social costs, and more cross-border sukuk activity have added further element and effort for a deeper and more sustainable ecosystem. Okay, right now I will be expanding on my part on question number 10. So I have to make I have to examine the allocation of RWA, which is risk-weighted asset, and what is related to their business strategy for Hong Leong Bank Islamic. according to their financial performance financial statement for end of 2017, Malaysia is expected to maintain a healthy growth in 2017 on improving their global microeconomic prospects and industrial activities, as well as sustain demand from regional economies, all of which are expected to lift the demand for Malaysian exports. Meanwhile, domestic demand continues to be stable, driven by a steady labour market and also wage growth, as well as increased investment activities. Reduced financial markets volatility and still a healthy banking system also predict well with overall growth prospect of the Malaysian economy. In the financial report, they stated that the bank will continue to pursue a sustainable growth in their domestic and regional business by embedding themselves in the community and strengthening their own digital offerings. At the same time, the bank remains committed to drive and continuous improvement in the business and strive to pursue operational excellence through strategic cost management. These two are the keyword that they are highlighted in their financial report, which is digitalization and also strategic cost management. And yep, that's it for question number 10.
Yeah.
Okay, right now I will be explaining on the last question, which is question number 11. At capital adequacy ratio 8%, how much capital is allocated for credit, market and operational risk? After looking thoroughly from their financial statement as of 2017, the capital allocated for credit risk is how to calculate the capital ratio allocated for the credit risk is by taking the credit risk RWA, which is 93,397,480 ringgit, and we times it with the CAR 8%, which is 0.08, and we got RM 7,471,793 ringgit. So this is the capital allocated for the credit risk, 7 million plus. So the next is how to calculate the capital ratio allocated for market risk. So for market risk, we take like the same from the question number 1. We take the market risk RWA 3 million plus, and we times it with the CAR, which is 8%, and after we calculate, we got 267,209 ringgit 52 cent, and this is the capital ratio allocated for market risk that the bank decided to put. So for the last question is operational risk. How to calculate the capital ratio allocated for operational risk? So like the same for the previous question, we take the operational risk RWA, which is 6,934,554 ringgit on June 2017, and we take the figure and we times it with the CAR 8%, 0.08, and we got, and for capital ratio allocated for operational risk is 554,764 ringgit 32 cent. So that's all. That's how you calculate the capital allocated for credit and market operational risk.